How can you use tax-deductible earnings from your business or professional practice to fund personal retirement benefits without including all your other employees like you do with a 401k pension or profit-sharing plan? Well, if your business is a C corporation or a limited liability company taxed as a C corporation, or if you can set up a subsidiary C corporation, you can take advantage of Internal Revenue Code Section 79. Code Section 79 sets the rules for employee group insurance benefits, and when combined with Code Sections 72E and 7702, Section 79 can enable corporate business owners to legally use tax-deductible corporate dollars to fund tax-free retirement benefits without any investment risk, and without funding retirement benefits for all other employees. Here's how it works. Under Section 79, the corporation establishes a non-discriminatory, low-cost, tax-deductible group life insurance plan with a $50,000 death benefit for all eligible employees, excluding any part-time or seasonal workers, as well as those covered by a collective bargaining agreement and those with less than 3 years of service. This benefit will typically cost the corporation no more than a few dollars a month for each employee. However, under Section 79, all eligible employees are also offered additional coverage, a voluntary benefit that is tax-deductible to the corporation, but taxable to the employee. And this additional coverage must be offered to everyone as a multiple of annual earnings, typically set between 2 and 10 times, which is the maximum the employee can take. For example, the multiple could be set at 6 times earnings. So a warehouse factory or office employee with $50,000 in wages could get up to $300,000 of additional coverage. While an executive officer of the corporation, like yourself, with a $200,000 salary, could get up to $1.2 million of additional coverage. What's more, those employees who take the additional coverage must also choose between 2 different types of coverage: low-cost term insurance that will end when they retire or leave the company, or prepaid lifetime insurance that will continue for as long as they live. However, because each employee must pay income tax on any of this additional coverage, employees generally do not take the additional coverage. And those that do take additional coverage almost always choose the low-cost term coverage. But you, the owner-employee, will choose the maximum additional coverage and also choose the prepaid lifetime type of coverage because the prepayment requires overfunding, which will produce a tax-exempt reserve value from which you can withdraw tax-free income during retirement. Of course, you must pay income tax on the value of this benefit, but that value is usually 30 to 40% less than the tax-deductible corporate expense. So the actual cost to you, the owner-employee, is only the tax on 60 to 70% of the corporate deduction. But because the income you withdraw from the plan during retirement can be 100% tax-exempt, this is an efficient use of corporate tax leverage. And that's because, under Section 72E, the money grows without taxation. And under Section 7702, the money can also be withdrawn as a series of tax-exempt loans against the tax-free death benefit. And these loan withdrawals are paid off tax-free under Section 101A when the insurance coverage eventually terminates at the end of your life. So, by including all eligible employees and by offering everyone additional coverage, a Section 79 plan can effectively discriminate in favor of the owner-employee, who voluntarily elects the additional lifetime coverage, while the other employees voluntarily do not. Consequently, a Section 79 benefit plan enables the owner or owners of a business or professional corporation to fund a tax-exempt retirement benefit for themselves using a tax-deductible corporate expense, but without funding retirement benefits for any other employees.